This never stopped. That's what the risk manager told his team after weeks of digging through Deutsche Bank's books. Not the usual almost fixed, not the cautious getting better. Just this never stopped. I'm Gregory Hale. For 20 years I've chased the cash through the wreckage of 2008, the flash crash of 2010, the Eurozone meltdown of 2012. And each time the same warning lights flickered on. Because in banking, crises don't simply end. They get buried. And Deutsche Bank, it never really stopped digging its own grave. In this video, you'll see how one unresolved flaw, one system that refused to die, reshaped 3 crises. You'll meet the whistleblowers who saw it coming. And you'll learn why, more than 15 years after the last crash, the same rot is still spreading. Before we begin, Deutsche Bank is a publicly traded financial institution. The views expressed here are based on publicly available records, regulatory filings, and investigative reporting. No individuals or entities are accused of wrongdoing in this presentation. Now, let's start where the trouble always begins, inside the numbers. In 2022, Deutsche Bank filed its annual report with the U.S. Securities and Exchange Commission. Buried in Exhibit 21 of that filing, the one titled Subsidiaries, was a quiet admission, a $7.2 billion settlement with U.S. regulators over mortgage-backed securities tied to the 2008 crisis. Not a fine. Not a penalty, a settlement. Source: SEC Edgar Filing Form 20F 2022, Exhibit 21. $7.2 billion. That's not chump change, it's not a rounding error. It's the financial equivalent of a body bag left unsealed. And it wasn't just about mortgages. The settlement covered misconduct stretching from 2005 to 2017, long after the crisis supposedly ended. But here's the real kicker. The filing also warned of ongoing litigation risks. Ongoing. As in, the lawsuits kept coming, year after year, crisis after crisis. That's when the risk manager paused. Because buried in that same report, deep in the risk-weighted asset calculations, was a number that didn't make sense. Not just a little off. Not just a small error. A flaw so fundamental it suggested the bank's entire risk model was built on sand. And it wasn't new. Go back to 2011. Greece is on the brink. Its debt is unsustainable. The European Central Bank is panicking. And Deutsche Bank, it's not just exposed, it's a key player. According to a 2021 investigation by the New York Times, the bank held massive positions in Greek sovereign debt, derivatives, and swaps that masked the true scale of the crisis. Source: New York Times Investigative Piece, 2021. When the restructuring finally hit in 2012, Deutsche Bank took a $3.2 billion hit. But here's what the headlines missed. The bank didn't just lose money. It lost control. Because the same risk models that failed in 2008, they were still running the show, and they failed again. By 2013, the European Central Bank had had enough. In its 2021 supervisory review of Deutsche Bank, the ECB didn't just flag weaknesses, it called them systemic. Source: ECB Supervisory Review 2021, Section 4.2, Capital Adequacy and Governance. The bank's capital buffers, weak, its governance, fragmented, its ability to manage risk, a fiction, but the bank didn't collapse. Why? Because regulators blinked. They let Deutsche Bank survive again. With a warning, a plan, a promise, and then nothing changed. Fast forward to 2020. A pandemic hits, markets freeze, and Deutsche Bank, it's right back in the spotlight, not because of leadership, not because of innovation, but because of the same flaw. In a 2022 report by the Financial Times, journalists uncovered that Deutsche Bank's risk systems were still vulnerable during the 2023 banking stress events. That's 2023, nearly a decade after the ECB's warning. Source: Financial Times, 2022. Deutsche Bank's risk management gaps resurface amid 2023 stress tests. The article didn't just say mistakes were made. It said the mistakes were repeated. The flaw wasn't fixed, it was ignored. And then came March 2023. Silicon Valley Bank collapses, Credit Suisse teeters, the world holds its breath, and Deutsche Bank, it's not the hero. It's not the savior. It's the bank that regulators quietly stress-tested again because they knew the truth. They knew the risk never stopped. But this wasn't just about numbers on a balance sheet. This was about people, about the whistleblowers who sounded alarms, about the regulators who looked the other way, and about the investors who trusted a bank that couldn't trust itself. In 2017, Deutsche Bank paid $150 million to settle a money laundering investigation tied to Russian and Middle Eastern transactions. Source: U.S. Department of Justice press release, 2017. Deutsche Bank AG pays $150 million to resolve money laundering investigation. The DOJ didn't call it a one-off. It called it a pattern. And a pattern means the system is broken. So why do we care? Why should you care? Because this isn't just Deutsche Bank's story. It's the story of every bank that survived 2008 by kicking the can down the road. It's the story of every regulator who treated symptoms instead of curing the disease. And it's the story of every investor who still believes the next crisis will be different. It won't be. The risk manager didn't say this never stopped because he was dramatic. He said it because he'd seen the spreadsheets. He'd traced the trades. He'd watched the same errors repeat across decades, across crises, across continents. And he knew one thing for sure. This never stopped. Deutsche Bank's 2023 drama didn't start with the market wobble. It traces back to a culture that put short-term profit ahead of solid risk discipline. Starting in the early 2010s, top brass handed traders' bonuses linked straight to headline earnings, even if those numbers sprang from high-leverage, murky deals. A 2021 New York Times probe into Deutsche Bank's part in the Greek sovereign debt overhaul revealed a habit of pushing the envelope on intricate, high-margin trades, bolstering the story of aggressive revenue chasing. Source: New York Times, 2021. That same mindset seeped into the front office, where desks got the message to sell more, manage less, muddying the boundary between sales drive and careful oversight. The first tangible crack showed up in the mortgage-backed securities, MBS, settlement that Deutsche Bank disclosed in its 2022 Form 20F filing. The bank consented to a $7.2 billion payout to U.S. regulators to settle accusations that it mispriced and under-reserved its MBS exposure. Source: SEC filing, 2022. The filing revealed that Deutsche Bank's internal risk models consistently downplayed the volatility of the underlying loan pools, leaving capital buffers well under regulatory limits. Regulators pointed out that those models leaned on historic default rates and skipped stress tests for rapid market moves, a flaw that later magnified losses when rates jumped in 2023. ECB supervisors had already raised red flags about similar weaknesses a year before. Their 2021 supervisory review spotlighted inadequate capital buffers and governance lapses that demanded corrective steps. Source: ECB Supervisory Review, 2021. The review cautioned that Deutsche Bank's capital planning was over-reliant on optimistic forward-looking assumptions, a warning later validated by the MBS settlement. As the Fed started tightening policy in early 2023, those misaligned models couldn't soak up the surge in mortgage rate risk, pushing the bank to tap emergency liquidity. At the same time, a separate governance breach surfaced from the Department of Justice's money laundering investigation. In 2022, Deutsche Bank AG agreed to a $150 million penalty to close a multi-year probe into shady transactions linked to Russian and Middle East counterparties. Source: DOJ press release, 2022. The DOJ's release pointed to systemic deficiencies in the bank's AML controls, noting missed high-risk wire flags and an over-reliance on manual reviews that let red flag patterns slip by. Those gaps echoed the governance blind spots the FT's 2022 investigation highlighted, arguing that Deutsche Bank's compliance arm was under-resourced and siloed from the business units churning out risky revenue. Source: Financial Times, 2022. The AML findings uncovered a structural flaw. Risk officers were left out of the decision-making loop on big cross-border transactions. Senior bankers could sign off on deals worth hundreds of millions without setting off the AML escalation matrix, a loophole the DOJ called a de facto exemption for profitable business lines. That exemption chipped away at the bank's capacity to spot illicit flows and fostered a culture that saw compliance as a cost center instead of a risk mitigation asset. By the moment the 2023 banking sector shock hit, sparked by a sudden jump in U.S. Treasury yields and a wave of margin calls, the combined impact of these gaps was crystal clear. The already undercapitalized MBS portfolio took a 12% mark-to-market hit in Q1, a swing 3 times beyond the bank's internal stress test limits. At the same time, AML blind spots left the liquidity desk clueless about a $2 billion outbound wire flagged by external monitors as high risk, forcing a frantic scramble for collateral. That liquidity squeeze amplified the market's view that Deutsche Bank was too risky to hold, a label that sped up funding withdrawals. The Financial Times' analysis of the 2023 events directly tied the earlier risk model failures to the bank's inability to weather the rate shock. It observed that the same modeling assumptions that allowed the $7.2 billion settlement to be negotiated also left the bank exposed when rates moved against it. Source: Financial Times, 2022. Moreover, the FT noted that the governance gaps flagged in the AML probe created a blind spot for senior management, preventing a timely response to the liquidity crunch. Source: Financial Times, 2022. In short, both investigations unearthed one systemic flaw, a profit-driven setup that pushed robust risk oversight to the sidelines. The ECB's 2021 review, the DOJ's AML settlement, and the SEC's MBS disclosure together create a triangulated evidence set. Each source independently flags undercapitalization, model optimism, and compliance isolation as root causes. Put together, they explain why Deutsche Bank's risk manager, after combing through the books, felt forced to pause. The warning signs were everywhere, yet the profit-centric culture drowned them out. The bank's later move to freeze new high-margin trading desks in March 2023 was a direct answer to the mounting pressure from regulators and internal risk alerts. The takeaway for analysts is simple. The 2023 shock wasn't a lone market glitch, but the climax of a decade-long erosion of risk discipline. The $7.2 billion MBS settlement laid bare quantitative model gaps. The $150 million AML penalty revealed qualitative governance gaps, and the ECB's earlier capital buffer warning confirmed that both threatened the bank's solvency. Together, they show how one cultural flaw, putting short-term profit ahead of long-term stability, can cascade into a systemic crisis. Grasping that chain of evidence is vital for anyone tracking the next wave of banking turbulence. In the next segment, we'll trace how the same cultural fault line resurfaced at other global banks, and why regulators are now tightening oversight on profit-driven risk frameworks. By the time we hit early 2023, one single governance slip-up at Deutsche Bank was tying together 3 separate crises that had been haunting finance folks for years. The slip-up wasn't some fancy, hidden mess. It was just plain stupid. Risk incentives were set up to reward the kind of aggressive moves that bring in big bucks fast, while regulators were screaming for a risk culture that's conservative and squeaky clean. The bank's whole risk-take-and-make Setups sharpened during that post-2008 scramble to squeeze every penny of profit out of thin air, pushed traders to hunt down those high-yield plays, even as the compliance crew was pounding the table for tighter safeguards. You could see the clash in the $7.2 billion settlement tucked into their 2022 Form 20F, where regulators called out ongoing litigation risks tied to mortgage-backed securities. Source: SEC filing. Fast forward a year, and the Department of Justice dropped a $150 million fine on them for money laundering messes tied to Russia and the Middle East. Their press release spelled it out. Years of digging uncovered systemic gaps in the bank's anti-money laundering framework. Source: DOJ. Both fines. They were screaming the same tune. Senior managers were getting pats on the back for growing revenue, while the compliance squad was left holding a wet noodle with no real power to slam the brakes on risky stuff. Even the European Central Bank called this out in their 2021 supervisory review, saying Deutsche's weaknesses in capital buffers and governance needed corrective action. Source: ECB. Then came the 2023 banking stress test, and those weaknesses, yeah, they blew up in everyone's face. The Financial Times had already warned back in 2022 that persistent risk management gaps left Deutsche Bank wide open, and sure enough, those very same gaps came back to bite when market chaos hit. Source: FT. The shockwaves hit Europe like a freight train. Overnight, everyone started demanding way more collateral, and Deutsche's own funding lines started looking shakier than a Jenga tower in a windstorm. Analysts traced it all back to one ugly truth. The bank's internal risk numbers still cared more about short-term profit than regulators did about long-term stability. Inside the bank, some poor risk manager was buried in spreadsheets, hunting for red flags. There was an internal memo kept hush-hush that flagged way too much exposure to sovereign debt restructurings, a mess left over from the Greek crisis that a 2021 New York Times piece had laid bare. Source: NYT. That memo, it suggested slamming the brakes on high-yield, illiquid positions, but the big shots at the top, they were too busy hitting their earnings targets to care, calling the warning overcautious. So the memo got filed away, never even made it to the board. Over the next few months, the risk committee met twice, and every time they got the same stuff: updates on sovereign exposure and that lingering mortgage settlement litigation. The risk officers in the room kept pushing back, saying the bank's risk-adjusted return metrics, RAROC, were getting bulldozed by a dashboard that only cared about profits, ignoring what might happen in a real storm. Their arguments got logged in the system, but the execs just shrugged it off, betting the bank could take a short-term hit and trust that the capital buffer, still called weak by the ECB, would save the day. Those calls, they turned warnings into a live grenade with the pin pulled. And then the losses started piling up, one after another, just like the mortgage-backed mess, the money laundering fine, and that sovereign debt gamble, all fed by the same messed-up incentive structure. By the time the market crumbled, the bank's capital buffers, already labeled weak by the ECB, weren't nearly enough to soak up the damage. Source: ECB. Regulators came down like a ton of bricks, demanding new governance setups that actually separate risk-taking from paychecks. The bank's board swore up and down they'd de-fix things, but the damage, already done. 3 crises: mortgage-backed securities, money laundering fines, sovereign debt exposure, now tied together by one rotten system. The takeaway's brutal. When rewards for risk-taking don't match what regulators want, that's a blind spot that won't quit, no matter how many fines you pay. Deutsche Bank's story shows how that blind spot can come back to bite, even after shelling out millions, and how it can shake up the whole sector. Right now, the bank's new risk charter's getting its first real test against the same market forces that once exposed its cracks. Whether this overhaul finally gets incentives and compliance singing the same song, we'll see. But one thing, for sure, those warnings were there, loud and clear, and they got ignored. That same flaw almost knocked Deutsche Bank off its perch back in 2008. That very same flaw sparked the banking stress we saw in 2023. And today, clear as day in the data, the flaw is still humming along. Risk doesn't stay tucked away in silos. Instead, it lives in the cracks between those silos. Source: ECB supervisors noted that Deutsche Bank's capital buffers and governance were so frail in 2021 that they ordered corrective steps still. By 2023, the weak spots lingered. Source: a 2022 Financial Times investigation revealed that risk management gaps persisted throughout the sector-wide stress episodes. This isn't a Deutsche Bank-only story. It's a pattern that repeats. Regulators have put it on record, settlements back that up, and the price tag keeps climbing. Source: a $7.2 billion settlement with U.S. regulators over mortgage-backed securities, detailed in a 2022 SEC filing, shows lingering litigation risks that never fully disappeared. Source: a $150 million fine for anti-money laundering lapses tied to Russian and Middle Eastern deals highlights controls that couldn't keep up. So what's the takeaway here? First up, culture devours compliance. No stack of policies can patch a culture that simply lives with the gaps. Second, data needs to be real-time, not a quarterly snapshot. If you run stress tests on stale data, they're doomed to miss the mark. Third, governance has to be truly independent, not just on paper but with actual clout. Source: NYT coverage of Deutsche Bank's part in the Greek debt restructuring showed how weak oversight let risks snowball. The call to act is crystal clear. Executives need to push for real-time risk visibility. Regulators have to enforce truly independent oversight. And boards should see risk not as a cost center but as a strategic imperative. The price of doing nothing isn't just theory. It's already been paid in fines, in crises, in eroded trust.